All right, to our first conversation, Nigeria's power sector has long been one of the biggest drags on the economy, trapped in a cycle of debts, weak liquidity, broken contracts, and endless bailouts. So this week, the federal government says it's turning the corner following the successful issuance of a 501 billion naira embed power sector bond and the signing of settlement agreements with power generation companies. So a lot of attention was given to the energy sector this week. All right, to help us unpack this, we have Onyebuchim Obiyemi. He's the Director, Head, Investment Banking, CardinalStone Partners. Is joining us via Zoom. And I have with me here in the studio Mr. Shino Sipasi, Partner, Head of Energy Infrastructure and Finance at Alex Legal. It's great to have you both on the show today. Let me start with you, Onyebuchim. Thank you for joining us via Zoom. But, looking at this bond issuance from a capital markets perspective, why would you say this? What would you say is so attractive about this bond? And raising this amount.
Okay, so I'll probably unpack it into three buckets. So I'll look at the enhancement of the bond itself, the pricing, and I'll look at timing. So from the standpoint of enhancement, there are a couple of things that are important. Who are the investors who would typically participate in these kind of transactions? We have the pension funds. And so one of the things that we ensured that the instrument had was PENCOM compliance status. So we knew that PFAs would definitely invest. The second bucket of investors that we knew we needed to get money from were the banks. And so one of the things that we chased up very actively was getting CBN liquidity status. So those bonds can have zero charge for their liquidity, capital and liquidity calculations. They can use the bonds for repo transactions and they can discount those bonds. And then we also secured tax exemptions, which means that no withholding tax charged on the interest paid on these bonds as well. And also the last was also on the FGN guarantee. From the standpoint of pricing, we tried to ensure that the pricing was very competitive. So it was an amortizing bond, so it was slightly priced just slightly below the 7-year comparable FGN instruments. And the last thing was also around timing. So we also saw that there were also FGN maturities December into January. And so we knew that we'll be awash with cash. And so timing, we tried to time the issuance also when we knew that the market had liquidity to support the issuance.
All right, thank you for helping us break that down. But let me come to you, Mr. Shino. So at this point, this was money owed, to these GenCos, and now the government is borrowing to settle that legacy debt. At this point, what legal frameworks actually make this kind of transaction possible?
Okay, so the structure that has been adopted for the bond issuance itself is an interesting one. The issuer is an SPV, more precisely an orphan SPV. Orphan in the sense that the issuer is not owned by any entity of the federal government. The issuer, all the shares in the issuer is owned by a share trustee, Sankore trustees or something like that, right? So it's orphan. It's not related to the federal government. MBET is the sponsor. The federal government itself will guarantee the bond. And there are all those other enhancements that have been created that I've just spoken about. The CBN granting the bond a liquid asset status, PENCOM allowing PFAs to invest in the bond, and a number of other enhancements. But that structure, as interesting as it is, from questions we've been hearing, there will be, it will be necessary to have some clarity around it. Why is it necessary for them to use for for an orphan SPV to be used, because the orphan SPV is bankruptcy remote from MBET itself. The other issue is issues around approvals for federal government to guarantee. I mean, the necessary, more like legislative approval required for the federal government to guarantee bonds issued by an entity that is not owned by the federal government. Those are interesting questions that require discussion, clarification, and also on that liquid asset status. This is usually done by CBN issuing a circular. I've looked around. I haven't seen the circular yet. Perhaps it is something that has been privately granted to the transaction advisors, and is probably in the transaction document.
Right.
But again, those are things that...
And talking about clarity, at this point, what legal and regulatory structure would you say is giving investors confidence in this?
Well, the issuer is legally set up. The issuer is legally set up under the laws of Nigeria. As a company, the issuer has a legal right and legal power to issue bonds. The sponsor has the right and legal capacity to be the sponsor, and there are contractual obligations between the issuer and the sponsor, which allows the sponsor, which is MBET, to transfer its receivables to the issuer, and also transfer its liabilities to the issuer. So there are contractual structure, legal structure that allows all of this to. So my first comment is basically some bit of gaps that are unclear, that all the transaction advisors and perhaps the sponsor need to make clear to the investing public, so that reaction and excitement to continue to invest in the bond can be sustained and placed on very firm, solid foundation.
Fantastic. I'm talking about, transaction advisors. Now, let me come to you, Onyebuchim. So, what would you say the investors are really buying into at this point? Is it Nigeria risk, power sector reform, or sovereign backing? What are these investors buying into?
Okay, so just a quick one. So thank you very much for the question. So I just want to speak to one or two things that he spoke about. So thank you for the comments.
Yeah.
So I think clearly, yes, an orphan SPV. It's sponsored by by MBET. MBET is a federal government institution, 80% owned by BPE and 20% owned by Ministry of Finance Incorporated. So all the different approvals, and for all the different approvals, requisitions that went to the different institutions were always, so the issuer was always backed by its sponsor, which is why he spoke about the issuer being sponsored by a government institution. So all the different approvals at CBN, at FR and NRS, and all the different approvals that were secured were always, so this issuer did not stand alone. In all the applications, the issuer, the orphan SPV, always leveraged the identity of the sponsor. And I think part of the also reasons why the SPV was really adopted was really, like you said, bankruptcy remote. And also there was a need to ring fence the entire debts owed to the GenCos and the receivables due from the discos as well. So that was part of the reasons why. And then also the funds are not commingled under general obligation bonds of the FGN, but the funds are directly disbursed to the GenCos who have signed the settlement agreement. So those are some of the thinking around this. And I think that when we had the investor presentation in December, we tried to provide quite a lot of clarity to the market. We had almost 1,000 market participants who attended that investor forum, where we tried to unpack the entire structure and provide a bit of clarity. And to your question, what are they buying into? I think for us, and all the engagements we've had all through this transaction, clearly they are buying into the power sector reforms, because it's a ripple effect. The GenCos today, the power that we all cry about today, the GenCos are unable to invest more in power generation infrastructure because their hands are tied and they have a liquidity squeeze. Now, what this does for the entire power sector industry is that money comes into the hands of the GenCos, they have more liquidity, they are now freed up to do more investment by extension can generate more. And also, I think, like I was also speak a bit more, that this whole capital raise is a part of a broader power sector reforms as well.
All right, so talking about the orphan SPV at this point, is this international best practice?
Yeah, so yeah, we've seen it done in a few kinds. It was not just in Nigeria. We've seen it also modeled in a few clients. We saw something like that done in Ghana, also in the power sector. So there were a few case studies about it. There were a few case studies. So, and I think just also to also mention, so part of the things that even when the approvals went to the Federal Executive Council was also part of all these were also in the approvals that came from the Federal Executive Council for it to be done as an orphan SPV and for, so all those, because we understood that it was very important that at the highest levels of authority, they could actually get the authorizations to be able to get the structure to the markets.
Okay, and how would you say this deal is structured for, to balance risk, return, and, long-term confidence? Because we know investors, they deal a lot in confidence.
So I think, first of all, prior to now, there's been quite some apathy towards investing in the power sector. So one of the things that we also tried to do in structuring this instrument was, unlike federal government issuances that would typically be bullet instrument, means that you wait to get your principal at the end of the life of the bond and you only get coupons. This was structured as an amortizing bond, which means that investors start to get a portion of their principal and their interest with every 6-month repayment cycle. So for them, from the financial standpoint, we call it's a shorter duration instrument. So the effective maturity of this 7-year instrument in the real sense is somewhere about 3.4 versus the 7-year instrument. So at least that solves for the maturity risk that investors may have. I think the bigger thing also is the wrap on the instrument, which is federal government guaranteed. So the instrument has the full faith and credit of the federal government of Nigeria. So you can be confident that on the day of repayment, you will get your money. And I can also mention, at the end of the day, this is just all part of a broader power sector reform.
All right, thank you so much for that. So let me come to you, Mr. Shino, now. So definitely, looking at this first one, what do you see, for 2026 when it comes to these GenCos getting their monies back and actually having the liquidity to actually give us power in this country? Yeah,
let me start by addressing some of the problems that have led into the debt accumulation in the first place. The reason for this debt accumulation is because of is due to insufficient tariff structure. And also the inability of the DISCOs to collect substantial substantial revenue from their customers. It is said by the presidential committee that is handling this that the debt that had accumulated between February 2015 and March 2025 was 4 trillion naira.
Which has risen more than that.
Yes, and this debt, like I said, is caused because of the tariff structure. And because of the tariff structure, the federal government has to come in with some subsidies. Now, it is interesting when you look at the Q3 2025 report by NEC. Remember that the debt that have been dealt with is between February 2015 to March 2025. Now, just for third quarter 2023, the report says that the federal government obligation, subsidy obligation, which is based on the tariff structure, is 458 billion naira. For the quarter before then, right, for the second quarter, the federal government obligation, again, is almost 500 billion naira. So when you look at the federal government debt, subsidy debt that has to be paid to the GenCos, for those two periods, we're looking at almost 1 trillion naira in 2 quarters. Now, so the issue is that here is an initiative to deal with existing debt, but the structure that perpetuated those debts is still in place.
So we've not sorted the legacy issues.
It is wonderful that those debts are going to be paid, because those debts really are going to help clean up the balance sheet of the generation companies and the discos, and that is really great. It should perpetuate or cause investment to flow into the sector. However, every investor will still be asking the question that the root cause or the root causes in the first place are still there. So government needs to come out to make it clear what are the things that will be done differently this time. Because really in 2025, I'm sure by the time we see the third quarter report from NEC, we might have exceeded 1 trillion naira in subsidy debt, right? And then we're in 2026, the problem is still persisting. The tariff structure still remains the same. There's still subsidy built into the tariff structure, because as long as consumers are not paying cost-reflective tariff, as long as those tariffs are not being efficiently collected, government will still be in a situation where it has to keep, subsidizing.
Right, and maybe issuing more
bonds
at this point. Yeah. So it's not just issuing the bonds and clearing some of the debt down. Yeah. It's about solving the existing issues that made us the foundational problem that made us
creating the debt
owe them so much at this point. I guess that's the message at this point. Thank you so much. It was great having you both. Onyebuchim Obiyemi is the Director, Head, Investment Banking, CardinalStone Partners. Thank you for joining us this morning. Mr. Shino Sipasi, Partner, Head of Energy, Infrastructure and Finance, Alex Legal. Thank you for coming on the show, sir.
Thank you.
All right, we'll take a break now. When we come back, we'll look at pension, all of the work you're doing, right now, and all that money you're saving aside so you can have money when you're not working. We'll discuss that industry, what to look out for in 2026. Just stay with us.